All right, let's talk about high probability supply and demand zones. Okay, people have sent me messages in reference to, hey, Mike, what are you looking for when it comes to identifying a high probability zone versus a low probability zone? Okay, so let's talk about it. I want to just make this a pretty quick video, but show you in reference a couple of examples. One, showing you a supply zone, and two, showing you a demand zone. But we're going to switch it today. Right now, I'm going to show you a demand zone first, and then a supply zone. And these areas are both high probability. Okay, and then I'm going to talk briefly about what I consider to be low probability. All right. So first and foremost, you must always, when trading, depict the overall direction of the higher time frame. A lot of times, guys, when I'm not looking, I'm looking directly ahead. I'm looking at my chart, and my camera's to the right of me. But anyways, so I always talk about trading in the direction of the higher time frame, right? That's what's going to work best for you, especially if you're someone that's new, a beginner trader. I'm not saying that you can't ever counter trend trade against the higher time frame, meaning, a lot of times I may not look at the 60 range chart or a 24 range chart or a higher time frame overall. I'll simply just look at what's going on my lower time frame, my entry chart primarily, most times my 12 range chart. Okay. I also talk about multiple confluence, using charts together and looking for trade setups based on a certain strategy, to where I'm using pair charts as a means of confluence. So I'm scaling down from my higher time frame down to my lower time frame chart, looking for a setup. But in this video here, I just want to talk about the difference of low probability versus a high probability setup in reference to or in relation to the zones, supply or demand. So taking a look here, so I'm not going to give the rundown or give you a narrative breakdown of you starting with the higher time frame. Okay, we're not going to talk about the strategy as a whole in reference to using paired charts. Okay, I'm just simply want to show you just very simplistically, specifically, zones that are high probability. Okay, one, again, a demand zone, and then a supply zone. Both of these are off the ES or the E-mini S&P 500. Okay, doesn't matter what market you actually trade. If you look for these type setups, and wait for the price to retrace back to them and look for rejection, as I always talk about, you can look for a good trade. Okay, possibly the trade going into your favor, or more so going into your favor if you wait for rejection at these zones. Okay, now I want to clear the air. Not every trade is going to work, so you have to practice proper trade management and know when to get out of a trade. All right, I talked about this in many videos prior to this one about where to possibly put your stop loss, or where to knowing where to get out of a trade or exit in the event, one being at the back end of supply, one you could place it at the median area of the supply, or one right below the candle from what you actually enter the trade in on the rejection. Okay, so there's three possible areas that you can put your stop at, or whether you trade with the hard or a mental stop, whatever the case is. But always figure out before you get into a trade where you need to put your stop at and where you need to get out at. So getting into the discussion about drawing high probability supply and demand zones. Okay, now take a look what happened here. Okay, now the market is moving to the downside. Again, this is off of a lower time frame, my 12 range chart. This is primarily my entry chart. We see lower lows and lower highs being made in the market. Okay, now price makes a low right here, and this is from September the 24th at roughly 9:15 in the morning. Okay, then it turns around and it starts breaking to the upside. Okay, all right, and when it does that, we break an area or break through an area of resistance right here, but we also break through an area of structure as well. Okay, so once price breaks through a break of structure or an area of structure, then we want to go ahead and mark off, in this case here, our demand zone, because when price is breaking structure to the upside, we're looking for a pullback to a key area of demand to take a continuation trade where long. Okay, so price break structure, I'm just going to mark this, okay, right here. all right, above this area here. I know that little arrow is probably not straight, lined, little crooked, whatever the case is. But anyways, breaks above 52 3/4. Boom, breaks up there. So we have to look back to the area of where there's aggressive buying that took place as the market was pushing higher to break through this area of structure. That's the key. Identifying the appropriate or correct areas where there's aggressive buying when we're marking our demand zones. In this case here, demand, break a structure above here, okay? So we go ahead and mark that supply, that demand zone, all right? So how do we do that, okay? Now, the way to do that is to look to see where the aggressive buying in this case here started at. Originally, it started down here at the bottom. But so there's a demand zone right here as well as a demand zone right here. Now, price can pull back and reject this area, or could break through this area of the zone right here and come down and test this area of demand as well. We have aggressive buying here. We have aggressive buying here. All right. So I can go ahead and mark off this first area right here as my first area of interest as a demand zone, and wait for price to come back to it. That's the key. Wait for the retracement back to the zone, okay? Do not take the trade as soon as price gets to that zone, all right? Please don't. Wait for some means of rejection. I talk about a break of candle in the opposite direction. I want to see primarily a full candle close in most instances, unless you're very aggressive, and then you can just take, I'll show you a break above a candle here. I'm going to show you right here. All right, but first and foremost, let's identify and talk about what makes this zone here a high probability zone. So in drawing this, okay, I'm going to go ahead and delete this area first, okay, because I want to show you how to draw it. Now, one of the key things in what makes this a high probability zone is the fact is that where the aggressive buying came out of this swing right here, this little swing within this larger swing here, I'll go ahead and paint that for you just using arrows, okay? Push up, pull back, break here, okay? Swing. But we got a smaller swing right here within this swing, okay? So that little area within, that's internal structure within that little larger area or swing here, okay? Now this area here, this is a swing to the upside within this swing here, but this is a demand area within the swing. So price can pull back to this key area right here, which is internal structure within this larger swing right here, all right? Because this was where the demand or aggressive selling took place at, okay? All right. So when price taps back into this area, and what we're looking for is to be able to draw our zone. But what we want to identify first and foremost, what makes this a high probability setup or zone, is there a gap? Is there a gap once price breaks above structure right here in this aggressive buying to the upside? Meaning, when price broke above this area here, this area of structure right here to the upside, okay, and came out of this swing, aggressive buying to the upside, all right, the moment price broke above this last down red candle right here within this small area or internal structure area right here, above 49.5, once it broke that, did price immediately come back to the top end of this candle right here, this top end of this red candle right here where this wick is at? No, it did not. Look what happens. Let me show you. Take the arrow line. It breaks above and doesn't immediately come back, okay? Now, it does break above with this green candle right here. It takes out the top end of 49.5. That green candle there. What happens then is, does price pull back any? Yes, okay? So, we'll mark the area or the gap in between the two candles, okay? So the top end right here of 49.5, and then when price broke with this green candle here, meaning taking out this red candle right here to the upside, the moment it broke above here and then broke higher here, but then it pulls back with the bottom end on this this candle right here, that wick right there. You see that wick? Price pulls back right there, leaving a gap in between candles, okay? In between the break of this red candle to the upside, and then price pulls back with the wick of this green candle here, leaving that gap right there. So that's what makes a zone a high probability zone, is if it leaves a gap back resting at the actual zone, okay, where price broke structure to the upside, took out structure right here, all right? So now that we have a gap, okay, And when price pulls back, left a gap here, it continues moving to the upside. So you have to wait patiently for price to do what? To retrace back to the zone, okay? So I'm going to go ahead and mark that zone now because there is a gap. Using this as rectangle box, the top end of this red candle, bottom end of that green candle right there, okay? This right here is the complete zone right here. Let's bring it up a little bit because look, price, the internal structure within this swing right here. Pushed up, pull back, aggressive buying to the upside. Left the gap right here, okay? So the last down red candle within this small swing right here, okay, that where the aggressive buying took place to the upside right here, this last red candle, I want to mark the top end of it, including the wick, and the bottom end of this green candle right here, including the wick, because when price retraced it back with this red candle, it broke even lower with this green candle right here that formed right here, okay? Before that candle closed to the upside, it turned back around and started pushing higher and close to the upside. So we want to mark the top end of that red candle with the wick, okay, including the wick, to the bottom end of this green candle. This is the full demand zone right here, and we have a gap. That's what makes this whole zone a high probability setup, okay? So we draw the zone, aggressive buying, with the gap resting back at the zone. Just wait for price to tap back into the zone. Now, once price taps back into the zone, what am I looking for? Okay, now if you're aggressive, all right, you could wait for a break of a candle, meaning when price breaks lower, taps into the zone. You see this last candle right here, okay? All right, before price turned back around, okay? Okay, so the moment this last bullish candle right here formed to the upside after it tapped into the zone here, you can look for the next candle to start to form above that area there. And if it starts to form, you can get in aggressive if you choose to. I'm not telling you to, but sometimes I'll do that. I'll get in aggressive, especially if I've got a nice demand zone, in this case here, or it could be supply, to where we have a gap at, and that makes it a high probability zone. So I can get in at the break, meaning right above this bullish candle here, and then for price closes with this green candle here, and then it starts to form the next candle to the upside. I can get in. One thing that you can also do is wait for it to be more conservative is a full candle closure to the upside. Now, before I get into the trade, okay, I need to identify, where I can take my profit at, okay, if I'm interested in the zone and I get the break of candle in the opposite direction, all right. So I'm going to be looking to take price where? Back up to where? Back up to at least the highs right here, resting at 61. All right, so again, taking the trade back up to 61 area, right? Now, again, most times what I like to see is a full candle closure up to the upside here, meaning even though we got this last tap in with this green candle here, this bullish candle to the upside, I want to see a break above 52.5. Now, price closed here. It didn't break above 52.5 until this bearish candle here we see here, this hammer candle to the downside right here, started to break above here with the wick. You see that? Now you can go long there. The market does pull back before it starts to push to the upside. So let's say you did get in, as this candle actually closed to the downside right here. So you could get in if you want to wait for the break here of 52.5. Okay, as this next candle starts to form right here, at some point I'm sure it started to show green to the upside. A lot of traders probably would get into that trade right there. But the candle didn't close to the upside. It actually closed to the downside and then closed to the upside. So, it's one of those things to where you can wait for it to start to break above 52.5 with this candle here. I'm sure it did started showing, was bullish at some point before it closed to the downside. Or you can wait for it to close to the downside and then take it on this next candle here at 53 right here when it closed to the upside right here above. All right, you can do that. Or what you could also do is scale down to your full range chart and look for an entry point off the full range, okay? Scaling down, okay? Give you maybe a little more, I guess, a better entry point is what I'm trying to say, all right? So anyways, so price pushes up, but then it pulls back. This is the key right here, is knowing where to place your stop at. I talked about that in videos. You can place it at the back end here at 48.75, 48 3/4. Now you're gonna have to, I would definitely give yourself some breathing room here, because the banks, institutions, they know people are placing their stops right here. So, and there's a couple places you can put your stop at. Below this area here, but give yourself some room, several ticks, few points, whatever the case is. Or you can put it at the median area. And I'll talk about of the demand zone itself or the back end of demand. It all depends on, what you're comfortable in doing, how much money you're looking to leverage in the market, how much capital you have, just a bunch of different things. But, I'm just showing you 3 general places where you can place your stop at. Either case, give yourself some breathing room, okay? So the market pushes up, boom, you're in the positive, it runs up to 58.5, and then it pulls back. It's doing that to hit, basically sell stops to stop traders out down here because they know traders have their stop right here, and it taps back into the demand zone again before doing what? Taking off to the upside, testing this high right here and breaking through it. So I just wanted to talk about the demand zone setup, and what is the key to look for is this gap right here. Okay, you want to when you start to see gaps resting at a zone after you get the break of structure, it makes the trade a lot more or a lot higher probability. Now, we're going to talk about a supply zone setup. This was a supply zone that I actually took today in today's trading session. I posted it over on the Discord community. Okay, so if you're not part of our Discord, I highly recommend you join the Discord by clicking on the link down. You can find it in the description portion of this video. Look down in the description portion, click on that link, and invite yourself into the Discord. It's free, and you can come over to the trading floor and engage in or watch at least, the trades that we as traders take that are part of the community. We post entries or images or screenshots of the trades that we actually take. And if you have a question about trades, that from one trader that may have taken or whatever the case is, question you can ask. We're comfortable enough in the community to explain our trades and why we took the trade. I'm not saying everyone trades the same way I do. I trade supply and demand. Some of them, lots of individuals do trade similar to the way I do, but then maybe they put their own twist on it. That's the beauty I talk about trading, is finding something that works for you and sticking with it, okay? But primarily, most of all of us trade the index futures. I just want to throw that out there. So come over and join us, here on the Discord community. Again, you can find that link down in the description portion of the video and invite yourself in, all right? As well as there's a general chat channel. If you're someone that's maybe new to trading futures and want to get into it and you have questions about it, you can ask over on the general chat channel on the server, okay? All right, so this is a break of structure to the downside right below here at 43.05.5, okay? Price swings back. We had a low here, swings back, break structure to the downside. Once price breaks structure, really all that's left to do is find an area of supply, okay? And there could be multiple areas of supply on this swing to the downside right here, this move to the downside. Now, looking at this is the first area of supply I would mark. The rest of these I wouldn't. I don't have any interest in them. The reason why, because there's no gap. There's a gap right here, okay? You see this zone right here? I'm going to move it up, all right? When price moved to the downside, made a low, lower high, broke structure to the downside. But again, within this swing to the downside, we have some smaller means of internal structure, okay? So we have to include those areas of internal structure as well. Now, this area right here, I wouldn't include because the fact is, when price broke lower, it came back to and filled this little gap or back to this little zone here. Okay, so I cancel that. I delete that. I'm not looking at that. Price broke lower, pulled back, broke lower here, okay, and finally broke structure to the downside, leaving this zone here. Now, why is this a high probability zone that I would be interested in? Okay, because we broke structure for one. Also, it left a gap. Remember, the key to a high probability setup, and for me, in my trading, how I trade, is the gap, okay, that's left behind. Price broke here, pushed down here, pull back, broke lower, okay? So this last green candle on the pullback right here, before it broke lower here, I'm gonna mark that area right there, all right? Okay? And then when price broke that last up candle to the downside with this green candle here, I need to see, did it immediately come back and fill or tap back into that blue arrow, that blue line right there at the bottom end of this last up candle right here where this wick is at, all right? Now, you got to pay close attention because if there's a small little gap right there, a small gap. I'm going to show it to you. Look here. Price broke this last up candle here to the downside with this with this red candle, right? All right, the next candle that formed, it did not immediately pull back to the tick, okay? So it left a, let's see here, that's 43 and 15 and a quarter, 43, let me see, 43.15 and a quarter down to 43.14 and a quarter. Is that correct? I'm sorry, 43.15 and a quarter and 43.14 3/4. So there's like a 2-tick gap right there, 2-tick gap right there. All right. So it's a very, very, very small gap, but there's still a gap there. So that makes this area a high probability zone. These two arrow lines are just marking off the small gap. See that very small gap? I know my lines are crooked. Please forgive me. All right. But that very small gap in between the bottom end of this green candle right here, okay, when it last pushed to the upside before it broke lower, and then when it finally broke lower and broke below this green candle here, the wick of it, that it broke right here, that red candle broke below that green candle, the bottom end. All right, it didn't immediately pull back. It broke lower, the next candle, and then it pulled back, okay, and wicked the top end of this wick on this red candle. It didn't come back and tap into the bottom end of the wick of that green candle. So it left a small little gap right there, okay? And that's the key to how I actually trade and looking for high probability setups of supply and demand. Small little gap there, 2-tick gap. So if you look to see what happened, let's go ahead and put the zone back, okay? Right there, all right? Now, the way I draw the zone, okay, price broke lower here, pull back, internal structure, push down, pull back, push down, pull back, broke lower, breaking below here, and then finally running lower and breaking structure, okay? So on this little internal structure area right here, I'm looking for the last green candle that pushed up to the upside, okay? Right here, okay, that last green candle. So I mark from in this case here, I got to mark from the top end of this the top end wick of this red candle right here, because as the green candle, the last green candle that pushed to the upside, this red candle, which at some point I'm sure it was green when it pushed up here before it closed to the downside right here, okay? So it pushed and broke above this green candle here, okay? So I didn't include the wick of this red candle down to the wick of the green candle, and that's my supply zone, okay? Once I mark that and price taps into and fills the gap back at the zone here, at the supply zone, I'm just looking for, again, a means of rejection, okay? It could be the break of a candle in opposite direction or scale down to the 4 range and look for some rejection there. Rejection could be information structure. It could be some zipping at the zone, meaning price keeps wicking out at the area. That's a sign of rejection. It could be, what's a break of structure at that zone there. It could be a change of character, where price kind of breaks below a level, pulls back, and you can look for a rejection to go short. There's multiple means of ways to look for rejection at a zone. Price breaks or taps back into the zone, excuse me guys, taps back into that zone. And then when it does that, I'm looking for the break of a candle in opposite direction. So price tap back into the zone with this red candle right here, okay? You see that? Wick of that red candle right there. So once price taps into that zone right there, and then it forms right here below. So what it does is it wicks into the zone, breaks lower. This green candle here, it did start to break lower. So at that point, most instances, because I'm very aggressive, I'm short at that entry point, okay? Once price starts to break on the next candle below this red candle, I'm short. But what happens is price does pull back, okay? It does pull back. So what you can actually do is look for, again, like I said, scale down to the lower time frame. But before I actually got into the trade, I was already sizing up to where I needed to get out of the trade at, or where I was going to take profit at least, okay? Was going to be right here at, I think, 4309. Let me take a double check. Let me double check again. I was looking over on the Discord to make sure. Yep, 4309 and a half is the area, okay? Definitely the area. So you can scale down to the 4 range and look for an entry as well. Because I talk about using multiple, charts as means of confluence. But if you take the trade directly off the 12 range chart, using just one chart, then you can take the break below here at 12 and a half, or like I said, it pulls back, and then you can wait for this next candle to close right here. Now if you do that, again, you're trading off a slightly higher time frame, not the 4 range, so you're not going to have too much room in between the area you're looking to take profit from in the full candle break right here at the bottom right here. So this is a tight area right here. So for me, I was aggressive the moment price tapped into this high probability setup or zone here by taking the break. So the moment price formed this last candle after it tapped into the zone, this red candle right here before it closed lower, once it closed lower, the next candle that started to form and break below here at 12 and a half, I was already short, okay? It did start to pull back, okay? It pulled back like 2.5 points, whatever the case is. As long as it didn't break, to to me, the median area of this demand zone, most times I'll get out. Or if you want to be very conservative with your trade, right here at the back end, okay, where price started to show signs of rejection, right here at 15.25, 15.5, give yourself a few ticks right there, because the market is going to probably want to test that area. And you see what happened. It broke lower. It came back. That's the banks trying to test those stops at that area, because they know people or traders place their stops right there when they got into a trade. So you may have got stopped out. So give yourself some breathing room, and then it goes in your favor. Okay. All right. Goes into your favor. It comes down there. It hits 09.5. All right. And then it tested again. It gave you a second test again before it ran, before it actually pushed lower right here. You can see it came down, boom, tested 09.5, breaks higher, taps into the zone again, and then, pushes lower. So I just want to talk about in this video here what makes in my case here, the way I trade supply and demand, what makes my setups high probability ones that are versus ones that are low probability. Okay, I tend to not take low probability setups, guys. I talk about that all the time. So I want to see that gap back at the zone. That's what makes it important for me. But that's all I wanted to cover and talk about today in today's video, guys. Hopefully you found some value in that. Hopefully those that have questions about the gap back at the zone, what I'm talking to, take some time and practice with it and see if you got a gap at the zones after you get the break of structure. The key importance, the break of structure, look for your zone, make sure you have a gap back at the zone, and wait for rejection back at that zone. Do me a favor. Click on the sub button if you're someone that's new to the channel, okay? You need to spend some time watching the videos, guys. You will slowly start to understand supply and demand if you're interested in trading supply and demand. So I highly recommend you become a part of the team, part of the channel, by clicking on the sub button down below. Make sure to turn on all your post notifications. I don't want to see anyone miss one of the uploads here on the channel. So by turning on your post notifications, that will ensure that you never miss one of the videos. You will be informed or alerted, okay, once I've made some new content and dropped the video, which I'm always dropping videos all the time, okay? So do yourself that favor, click on the sub button, subscribe to the channel, click on the bell, turn on all your post notifications, and last but not least, drop a like on the video, guys. I appreciate it. I'll see everyone in the next video, and if you're trading, please be safe in the market, and I wish you a successful trading day.